All right, it's time now for Hot Picks, and today we're doing something a little different. Normally we got 3 stocks. Today it's 3 bonds, and they're not all long ideas. Let's bring in Konstantin Boehmer, Senior Vice President and Portfolio Manager for Mackenzie Investments. Our first bond hot picks. So you're already breaking so many barriers for your fellow brethren on the desk. Can we just spend a minute, though, just talking about how the bond guys and gals are viewing the market compared to our friends in the equity market? Because they don't seem to be paying attention to a lot of the things that are coming up from central bankers.
Yeah, sure. So in fixed income, there's a lot of interesting stuff happening right now. So the big trade, of course, is disinflation, right? We've heard, I think in Powell's last speech, he mentioned it 15 times or so. So that has been a huge tailwind for fixed income performance since end of last year and into this year. So bonds have been rallying all across. But I think now we're at a stage where we have to maybe look at, is that all fair and square, or are there some other pieces that we need to discuss? And the big ones, for me at least, are on the growth side, where we've seen China reemergence, Europe didn't collapse, and then we have, thirdly, the US consumer holding up and the labor market doing fantastically well. I mean, also here in Canada, but just that strength that we have seen there is a little bit of a surprise, I think, to many. And then we see financial conditions also becoming looser and looser. And that is in an environment where, as a fixed income investor, this doesn't look all that great. We love the disinflationary part, but we really don't love the growth aspect of it all too much.
Okay, so with that in mind, let's get to some of your hot picks. Shorting the U.S. 30-year bond. Is this a call on shorting a rally that you think may be a little overextended?
Yeah, exactly. So I would say for the entirety of 2023, I'm pretty positive on bonds overall. But right now, at this stage and how much we've rallied, this appears to me a little bit too far and too fast. And if I look at the communication that we're getting from central banks, I think there's a little bit of a reckoning that is upon us, where we do not seem to be in restrictive territory when it comes to central bank policies. And that is something, until they recognize that, I think the long end of the curve can adjust quite a bit higher. So
we've already seen that, right? And if we can pull up that chart again, the 30-year, we've already seen yields pick up. You're talking about them picking up, what, to above 4.5%?
Above 4.5%? Hopefully not. But I would expect another probably 50 basis points. I wouldn't be surprised, right? There's a lot of uncertainty in markets. We're data dependent right now. So it is all about the economic data that comes out, but the recent ones have been quite hot, and I see very little trend change happening, and that hot data is coming out of Europe, it's coming out of China, it's coming out of the US, it's definitely coming also out of Canada. So there seems to be a momentum behind those better prints on the economic side, and once that feeds into also the reckoning from the central banking side, there could be some potential for higher rates.
Is this a trade, when you're talking about shorting bonds, is this a trade that a retail investor can kind of put on, or the things you need to know when you're shorting bonds?
Yeah, you can. There are ETFs that you can do. TLT is a very popular one, so you can buy an option on it, or you can, I'm sure there's also an inverse of that. Maybe as a recommendation for your viewers, volatility is still super expensive, so buying options is a very expensive trade here.
All right, your other one is long inflation-linked bonds, and I guess this is on the bet that what if we're not winning the battle on inflation?
Yeah, it is that trade-off, and I would maybe add one piece to it, and that goes along the comment that I made that for this year, bonds still look good. This is more of a trade right now. But for the long run, bonds look decent. And what we have, I think, also on this slide here is just they've underperformed inflation-linked bonds. But what you get now is 1.5% real yields. So the way that linkers or inflation-linked bonds work, you get some yield, and then you get inflation compensation on top. So that yield that you're getting is 1.5%.
Why wouldn't you just always own this?
Great question, yeah. So because your purchasing power is going up by 1.5% because you don't have to care about inflation. At least CPI, the reported inflation, you don't have to care about that. And 1.5% for the safest asset in the world, US Treasuries, doesn't sound so bad to me.
And lastly, you want to short, right, the Japanese 10-year.
Yeah.
And that sounds like a really interesting call, given there's all kinds of stuff that the Bank of Japan is doing to buy up and do yield curve control.
Yeah.
Is this not a dangerous trade?
I don't think so.
Okay,
but
okay.
It is
but explain to me, when you've got
one.
the central bank so involved.
So they have bought, I think, $500 billion worth of bonds just in the last 3 months.
Yeah.
So incredible amount of purchasing from the central bank. And that is, especially when you look at that chart, that's how they manage to keep it so tight in terms of how the yields of that segment move. But at some point, you have to stop doing things that doesn't make a lot of sense. And I think we're approaching that. And we're seeing probably tonight the announcement of the new governor of the Bank of Japan. They didn't go for all-out hawkish, but I think the train has left the station. Inflation is way too high. We're also in Japan at 4%, not the levels that we see here. But the train has left.
For them, that's a big deal.
Exactly.
For decades high, right?
That's right. So the train has left the station, and it's just a matter of time until they loosen it up. My expectation would be, even for the next meeting in March, that they will loosen that yield curve control.
Meaning tighten you become tighter as a central bank.
Exactly.
Yeah.
And that is that it has a potential then for those bonds to move a little bit higher. If bond yields go up, you want to be short.